Welcome back to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my initial research checklist. Today, we're shining the spotlight on Cintas Corporation, ticker symbol CTAS, and uncovering what makes it a potential new investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. My 33-question checklist evaluates companies across 9 categories, which helps me gain a holistic understanding of the business. So far, I have screened 237 stocks across 9 sectors and 70 industries. The mean quality score is a 61%, and the top quartile benchmark is 70%. For Cintas, I rated them in November 2024, and data used for this episode is as of Q1 26. They earned a 82% quality score, which ranked in the 94th percentile overall and the 95th for their sector. This gets a pass rating. Let's now discuss Cintas's business. They are in the business and consumer services industry within the larger industrial sector, and as of October 27th, their market cap is $76 billion, so they would be a large cap by classification standards. Their trailing 12-month revenue is $10.6 billion, and their beta sits right in line with the market at 1.0. As I researched Cintas, I didn't realize that they actually began in 1929 as Acme Industrial Laundry Company when Richard and Amelia Farmer actually collected and cleaned used rugs for businesses. Then in 1957, their grandson joined, and by 1959, he actually pivoted the company toward uniform rentals, which is the foundation of today's business. The company rebranded in 1972, went public in 1983, and steadily expanded through organic growth and targeted acquisitions. Its decentralized model lets local branches act as profit centers. They have doubled down on what they call a partner culture, which is their name for employees, with profit sharing, internal promotions, and a 50-year-old values handbook. That's driven low unionization, which is less than 3%, and high retention in tight labor markets. Today, Cintas operates in a mature but durable stage of its life cycle, a market leader in uniform and facility services focused on incremental growth through share gains, service line extensions, and efficiency improvements rather than transformational pivots. In terms of what they sell, you can think of Cintas as the engine for workplace readiness. They quietly ensure uniforms, safety gear, and facility supplies flow to customers every week. Their core offerings include uniform rental and laundering, mats, towels, restroom, and hygiene supplies, first aid, eye wash stations, and safety training, as well as fire protection services and water services. They sell to other businesses and have around 1 million accounts across North and Latin America. I rate their services as essential as they keep the workplace compliant, safe, and presentable. According to their 10K, no single customer contributes more than 1% of revenue, which gives them a highly diversified base and low customer-specific risk. Turning attention to their business model, we'll start with the CFRA risk profile, and they give Cintas a medium risk rating with key exposures to rising energy costs, wage inflation, and labor shortages. But they do have some offsetting strengths like the #1 market share in uniform rentals and a diversified customer base with steady demand. About 95% of their revenue is largely recurring from services delivered on weekly or bi-weekly routes through multi-year contracts with 0 to 2% price escalators and automatic renewals. This means that only about 5% of revenues comes from what they call direct sales, which are uniforms sold outright, and these are more transactional and sensitive to economic cycles. How they recognize revenue depends on what type of sale. For rental and facility services, revenue is recognized over time as services are performed. For direct sales, revenue is recognized at a point in time when goods are transferred to the customer. I do believe that Cintas has strong pricing power in its core rental model due to high switching cost and regulatory compliance, and the fact that uniform rental is usually a small line on most customers' financial statements. With that said, I do think that pricing is going to be a little bit more elastic in those large direct sales contracts. Morningstar agrees and gives Cintas a wide economic moat, anchored in scale and switching costs. They note that its dense national route network allows it to service customers at a structurally lower cost than smaller competitors, which creates a durable cost advantage that compounds as the network grows. Changing uniform providers mid-contract is also expensive and disruptive, and that stickiness is reflected in mid-90s retention rates. They also have proprietary operational tech like TrueCount, SmartTruck, and MyCintas that helps improve route optimization and deepens customer integration. If you add in exclusive partnerships, like its uniform rental relationship with Carhartt, and you have a wide moat business. Cintas reports 3 primary segments. The first, uniform rental and facility services. This is their core segment, and it has the lowest operating expenses. This segment generated $8 billion in revenue as of fiscal 25, which was around 77% of total and plus 6.8% year over year. This segment has consistently delivered high single-digit revenue growth, and it includes things like uniforms, garments, mops, and restroom supplies. The next segment is first aid and safety services. Think of this as their growth engine, and it's the highest gross margin segment as well. This segment generated $1.2 billion as of fiscal 25, which is around 12% of the total, and a plus 14.1% year-over-year increase. Outside of 2022, this segment has delivered consistent low double-digit revenue growth. And this segment includes things like first aid cabinets, eye wash stations, and workplace water. They then have an all other, which is similar in size to the first aid and safety services at $1.1 billion, but it is more cyclical. As of the latest fiscal year, it was up 7.7% year over year, and it's delivered double-digit revenue growth from 2022 to 2024, but did tail off into high single digits this past year. It includes things like fire protection, think inspections, extinguishers, alarms, and those direct sales, which are usually uniforms for larger enterprises. There is no geographic breakouts, so think of Cintas as a mostly North American business. Supply chain and operations is something to pay attention to with Cintas, and it's interesting that in my research, they actually have a hybrid supply chain model that blends both in-house production and third-party sourcing. Most of its finished products are sourced from external suppliers, but it also operates 5 manufacturing facilities, which to me gives the company nice flexibility. On the distribution side, they have over 12,000 delivery routes, 400 plus operational facilities, and 12 distribution centers across North America. Now, as we know on this channel, a strong company is only part of the equation. You also need a great industry. So let's take a closer look at the landscape that Cintas operates in. For Cintas, we'll use the global uniform industry as their TAM, and I rate this as moderately attractive. And what I note here is that outsourcing tailwinds offset a cyclical exposure to employment and business activity. Growth in the US is not exactly exciting, but non-US does offer some exciting potential. From a 5 forces perspective, there's a low threat of new entrants given high route density and capital requirements, with moderate buying power since large customers can negotiate, but switching costs are high, and low to moderate supplier power due to diversified sourcing and in-house manufacturing. The threat of substitutes is low, and I have competitive rivalry as moderate, with a few scaled players and many fragmented local operators. In terms of the industry size and growth forecast, according to Uniform Market, the global uniform industry TAM is around $68 billion in 2025, with North America representing 40%, followed by Europe at 30%, Asia Pacific at 23%, South America at 5%, and Middle East and Africa at 2%. Management frames the opportunity slightly different as they use customer count. They have around 17 million businesses across North America that could be served versus around 1 million currently served, which implies a long runway for first-time outsourcing and cross-selling opportunities. This was specifically noted in their Q3 25 earnings call, if you want to take a look. Morningstar also notes that significant white space remains in healthcare, where many hospitals still launder scrubs internally. They further note that Cintas holds around 40% of the uniform rental market in the US and around 25% of the US facility services market, making it the clear industry leader. In terms of growth forecast, stockanalysis.com analysts project a 5-year revenue CAGR of 8% for Cintas versus uniform markets industry CAGR of around 4.3%. Regional growth is expected to average around 6.3% in Asia at the highest, 3.7% in South America, and then around 2.5% in both Europe and North America. This does suggest that there should be continued market expansion for Cintas in North America, even though its core geography is growing more slowly than faster rising Asia Pacific. One thing investors should look for is any commentary from Cintas around Asia Pacific as a new geographic region for expansion. Looking at the competitive environment, Cintas faces a small field of scaled rivals. Its closest direct peers are UniFirst, ticker symbol UNF, and Vestas, ticker symbol VSTS. The latter spun off from Aramark's uniform division in 2023. Both compete in uniform rental and facility services, though neither matches Cintas' national scale or margin profile. For example, UniFirst has around 4,600 in fleet versus Cintas' 14,000, and they only have around a third of the customer base and half the facilities. Aramark, ticker symbol ARMK, still manages around 300,000 or so uniform programs, but they remain mostly exposed to food service and education, which makes it more of a cyclical operator. There's also Ecolab, ticker symbol ECL, which overlaps some in hygiene, sanitation, and infection prevention, so they compete with Cintas more in their first aid and safety services segment than uniforms directly. Looking at some customer metrics incomparably, and UniFirst is actually the leader here. Cintas has a 74% customer loyalty score, which trails UniFirst's 90%, but they do sit above Aramark at 62%. In terms of NPS, Cintas is a +1, and that's modestly above the industry median of -4, but UniFirst does lead again with a +38. In terms of financial metrics, I use Fiscal AI for competitive comparison there, and Cintas is the clear leader among their peers. Their 5-year average gross margins and free cash flow margins top the group. They also have a 5-year ROIC that's roughly double UniFirst and Vestas' ROIC, and their 5-year revenue CAGR of around 8.5% is above the around 5% for peers, but it does come at trading with a higher valuation than peers, and only Ecolab comes close in terms of forward PE and EV to free cash flow. I then thought it would also be interesting to look at sales per employee, and Cintas consistently generates over $200,000 per employee, which is much higher than UniFirst at $150,000 and Vestas at around $143,000. Next, we'll tackle 10 questions that outline their quality growth profile. Keep in mind, this is mostly backward looking to gauge their historical quality, while the valuation section of this podcast layers in those forward factors. My first question is 5-year trailing revenue stability, at least 0.84, which is my weighted portfolio average. And this is a revenue consistency metric that incorporates both trend and volatility. For Cintas, this is a yes, and it's actually at 0.95. And then I second like to ask, is the 10-year SBC adjusted free cash flow linearity at least 0.77, which is once again my weighted average. And for Cintas, it's a yes at 0.97, which I think is the highest of any company that I've tested. So far through the predictability section, they're 2 out of 2. Then turning our attention to profitability, is 10-year median gross margin at least 40%, which indicates at least some pricing power, operating leverage, or differentiation. This is a yes again at 45.9%, and it's also worth noting that they have a lower standard deviation than my portfolio weighted average. The second question is 10-year median SBC adjusted free cash flow margins, at least 15%. This is their first no, as their 10-year median is 13.2%, which is just slightly lower than my 15% benchmark. So for profitability, they get a 1 out of 2. Then turning our attention to 3 growth and conversion questions, I'd like to ask, is the 10-year revenue CAGR at least 5%, which is my minimum baseline for long-term compounders? They're at a yes. They had a 10-year revenue CAGR of 9%. And then is the 10-year free cash flow per share CAGR at least double digits, 10%? And for Cintas, that is a yes. They were at 18.7% the last 10 years. And then is 10-year median free cash flow conversion at least 75%? So are they converting most of their net income into free cash flow per share? And for Cintas, this is a yes. They were actually at 100% for the last 10 years. So they get a 3 out of 3 for the growth and conversion. And then wrapping up the value creation section, is 10-year median ROIC at least 20% and ideally greater than the NYU database industry average? They were a no. They actually at 16.6% in the last 10 years, which is also lower than the industry average of 26.8%. I then ask, is ROIC trending up if low or holding steady if high? For Cintas, yes, it has been trending up since 2017, and they actually reached a 10-year high in fiscal 25 at 23%. I ask a new question in this section that I'm kind of playing around with, and it's called the value compounding rate. And it asks how fast a company can grow its intrinsic value each year based on how much it earns on its money, which in this case is ROIIC, and how much of those earnings it reinvests, which in this case is their reinvestment rate. And so I ask, is the 10-year value compounding rate at least 10%? For Cintas, it was a yes at 12.4%. So in this value creation section, they get a 2 out of 3, and overall they got an 8 out of 10. We'll now dive into a high-level overview of their 3 financial statements. First, the income statement. We did already talk a little bit about revenue per employee, but I did want to also comment that it has compounded nicely at 5% over the last 10 years and is currently above the NYU database industry average, although slightly below my database's sector top quartile. Turning our attention to margins, they have consistent increases over time in gross margin to now almost 50%, similar with operating margin, which is now almost 23%, and net profit margin, which is now around 18%. The biggest driver of COGS is the line item cost of uniform rental and facility services, which consists primarily of production expenses, delivery expenses, the amortization of in-service inventory, and inbound freight charges. Cintas has slowly decreased this percentage from 53% to 50% of revenue over the last 5 years. In terms of operating expenses, they only report one line item, selling and administrative, which includes sales labor and commissions, payroll taxes, and a few other things. It's also decreased over the last 5 years from 58% of gross profits to 54%. They also have a strong interest coverage ratio with a 10-year median of 13, and this is right in line with the Guru Focus industry median and above my benchmark of 10, as well as Benjamin Grant's minimum of 5. Looking at the balance sheet, the top 4 assets, which is cash, accounts receivable, inventory, and goodwill, make up around 70% of assets, with goodwill the highest at 35% in fiscal 25, followed by inventory at 16%, then accounts receivables at 14%, and cash at 3%. I usually prefer goodwill less than 30% as a general rule of thumb, but Cintas does not have a history of write-offs, so I'm not too worried. I think one metric on the balance sheet that is interesting to look at for this business is asset turnover ratio, which is just revenue divided by total assets. It measures the efficiency of the asset base in generating sales. And over the last 20 years, Cintas's ratio has been consistently between 20 and 30%, which I don't think is too bad for this kind of asset-heavy model. And as of fiscal 25, this turnover ratio sits near the high end of its 20 range at 0.28. And the stability in this metric to me really reinforces the operational discipline and their ability to compound earnings without overstretching that asset base. The top 4 liabilities make up around 80% of liabilities, with long-term debt the highest at 47% as of fiscal 25, followed by accrued expenses at 17%, and long-term deferred tax liabilities and accounts payable, which are both at 9%. The deferred tax liabilities are worth calling out here. They're non-cash obligations that arise from timing differences between how Cintas records expenses for accounting versus tax purposes. So for example, using accelerated depreciation on uniforms and equipment. In practice, this lets Cintas defer cash taxes and retain more operating cash flow today, effectively functioning as a low-cost source of financing rather than a traditional liability. For Cintas, inventory management is also important because it directly affects their route efficiency, working capital, and service reliability. Over the last decade, inventory has scaled in line with revenue, with only a 5.9% average variance between the two. And days inventory outstanding has improved dramatically from 99 days in 2016 to around 30 days in 2025, reflecting tighter inventory turns. I track 3 ratios to judge financial stability, and Cintas scores well across all 3. Their debt to equity has steadily improved over the past decade, falling from 1.36 in 2017 to 0.59 as of Q1 26, which is well below my 1.5 threshold. Their cash to debt does remain light at just 0.05x compared to a 1.03x industry median. And finally, their debt to free cash flow, which to me is the perhaps best solvency gauge, has fallen from nearly 7x in 2016 to just 1.6x today, comfortably below my less than 3x benchmark. In short, their balance sheet is strong, predictable, and de-risked. The company runs lean on cash, but they more than make up for it with powerful recurring free cash flow. Speaking of which, Cintas generated $2.17 billion in operating cash flow in their last fiscal year, which was up modestly from $2.07 billion the prior year. Cash inflows rise when accounts receivable and inventory levels are tightly managed, or when accounts payable expands. Conversely, cash flow dips when their receivables or inventories build. Over the past decade, they've converted a median 100% of earnings into free cash flow versus my portfolio average of 119% and my personal benchmark of 75%. This consistency signals high cash quality. I then like to look at SBC intensity and capital intensity. Stock-based compensation has been modest, averaging around 1.6% of revenue and 8.6% of operating cash flow over the last 10 years. And this is right in line with the industry average on revenue and my weighted portfolio average on operating cash flow. I rated CapEx requirements as medium, as they have a 10-year median of 4% of revenue. And interesting enough, the industry average using the NYU database has actually been negative at negative 0.1%. Now, let's talk about who's actually steering the ship at Cintas and whether their incentives line up with long-term shareholders. Cintas is led by Todd Schneider, who's 57 and became the CEO in June 2021 after more than 30 years with the company. That makes him a long tenured manager by my classification. His CEO tenure has been around 4.3 years, which is pretty close to the US average of 4.8. And the broader leadership team averages around 4.3 years of tenure, and the board averages 9.3, which to me suggests a pretty stable, experienced group at the top. I then like to look at employee sentiment on Glassdoor. On Glassdoor, 73% of employees say they'd recommend Cintas to a friend, which is just above the 72% median in my database, and 77% have a positive business outlook. That's a solid endorsement of company culture. In terms of how they're paid, I looked at the 14A, and in fiscal 25, Schneider earned $9.25 million, with only around 12% base salary and 88% tied to performance. His pay package is actually below the $13.5 million median for similar US-sized companies on simply Wall Street, which suggests pretty reasonable compensation governance. Their pay design is simple and pretty long-term oriented. Around 84% of total pay is tied to measurable financial performance. Their annual bonuses depend on EPS growth at around 43%, sales growth at also around 43%, and non-financial goals at around 15%. My only gripe here is around the 15% weighted non-financial goals. I think it probably deserves a little lower weight. But then looking at long-term equity awards, they're evenly split between EPS and sales growth, with payouts ranging from 0 to 200% based on results. Schneider owns around 0.2% of shares outstanding, but it's interesting that Cintas enforces a strict ownership policy where the CEO must hold at least 6 times his base salary in stock and all other NEOs 3 times. From what I see on the 14A, all current executives meet or are on pace to meet that threshold, and failure to maintain that actually results in potential reduced future bonuses. Looking at capital allocation, Morningstar rates their capital allocation as exemplary, which reflects a long record of disciplined reinvestment, measured M&A, and shareholder-friendly distribution policies. This is reflected in their total shareholder distribution, which has a 10-year median of 78%, comfortably below my 100% threshold. Remember, this is dividends plus buybacks divided by free cash flow. And they've also declined their diluted shares outstanding by around 13% over the past decade, reflecting consistent repurchases. Somewhat surprisingly to me, they actually have a low median acquisition intensity at 6.6% of operating cash flow over the last decade. They were active in a few years in 2016 at 34% and 2017 at 275%. But most of their activity there was opportunistic rather than habitual. The 2016 G&K Services deal remains their largest acquisition ever, and this deal helped expand their uniform rental network reach. I'd then like to do just a quick alignment check. From an insider ownership perspective, the founding Farmer family actually still owns 14 to 15% of shares outstanding, and the current executive chairman, Scott Farmer, is the son of the founder. This meets my 10% benchmark, and I like this insider ownership here. Institutional ownership's around 64 to 65%. I prefer 75%, but it's still typical for a high-quality, mature compounder. And insider buying, selling, it's mostly been a net negative, but nothing major to call out there. And while management doesn't publish formal 5 to 10-year targets, they have consistently reiterated a double-digit growth framework, aiming for high single to low double-digit revenue and EPS growth through a mix of organic expansion and small bolt-on acquisitions. Turning now to KPIs that I track with Cintas, one gripe that I have with them is that they don't formally report customer retention rates or other KPIs that you might expect from a service company of this scale. So as investors, we have to build our own scoreboard of what's available. The first KPI that I would track is return on incremental invested capital. This measures the return Cintas earns on each new dollar it reinvests, while ROIC reflects how strong the business is today, which is around 25%. ROIC shows how strong the next dollar will be. Over the past decade for Cintas, this actually averaged 30% plus using both straight line and lagged methods, meaning that it's generating over 30 cents of NOPAT for every new dollar invested, which is an exceptional reinvestment yield. And with a WACC around 10%, any sustained drop below 20% would signal that the reinvestment quality or capital discipline is starting to weaken with the business. The next KPI that I would take a look at is Days Inventory Outstanding, or DIO. We've talked about this a little bit, but it's a key operational lens, and it has improved from 99 days in 2016 to 30 today, freeing up that working capital and improving cash returns. If DIO stability stays at or near these levels, then it indicates the company is running a lean and scalable network. But if it does begin to climb without a surge in revenue, that would flag potential excess capacity or softening demand. Okay, let's wrap up now with valuation and technicals. I like to take a hybrid approach to valuation with both multiples and intrinsic value methods. For a company like Cintas, they're mature, steady, highly cash generative. I'll focus on free cash flow and operating income. I'll use two free cash flow methods, DCF and SBC adjusted free cash flow yield, and then also look at EV to EBIT and a forward EV to EBIT. I ran a discounted cash flow analysis on investorsgrow.com using 30 analyst free cash flow estimates through 2029, followed by a 10% annual free cash flow growth assumption for the next 6 years and a 2.5% perpetual terminal growth rate. All of that with a 9% discount rate yields a fair value estimate of $118 per share, implying that the stock is around 44% overvalued versus the current price of $187. That translates to an expected IRR of around 6%. Looking at the SBC adjusted free cash flow yield method, on a trailing 12-month Q1 26 basis, their yield is 1.81%, with 2026 forward slightly higher at 2.12%. The 3, 5, and 10-year medians are all higher, and the implied share price at the 10-year median of 2.58% would be $143, implying 24% overvalued, versus $206 if you use the 2026 forward yield, implying a 10% undervaluation. It's worth noting that their 2026 forward yield calls for $1.975 billion in free cash flow, with modest SBC increases, and they're already doing $1.702 billion trailing 12 month. So I think this is very achievable. Turning over to the multiples for EV to EBIT, on a trailing 12 month basis, they trade at a 36 times multiple versus a 3-year median of 34.2x, a 5-year median of 28.3x, and a 10-year median of 26x. If we apply the long-term 10-year median multiple to today's trailing EBIT and shares outstanding, we get an implied share price of $148, or 21% below current price. Peer UNF has consistently traded at lower multiples, while ECL traded at higher multiples for a while, before now trading at a lower multiple of 29.7x. On a next 12-month basis, Cintas trades at a 30.1x EV to EBIT versus a 5-year median of 27.3x. This is also above peers UNF at 16.9x and ECL at 25.8x. Applying that 5-year median multiple and a trailing 12-month shares outstanding to current enterprise value gets us a forward EBIT of $2.599 billion, which implies a stock price of around $167, about 11% below today's price. Before we get to the verdict, let's briefly talk some technical analysis at the $187 current price. For the 1 year, I'm using a linear scale and daily data, and for 5 year, I'm using a log scale and weekly data. So on the daily 1 year linear, the stock remains below all major EMAs, the 20, 50, 100, and 200, with the 200-day near $205, signaling a short-term downtrend. Momentum is weak, and buyers haven't yet defended the $190 level. On a log scale, the long-term uptrend is still intact above the 200-week EMA, around $161. However, the stock has clearly broken below its 50 and 100-week averages, which are around $203 and $189. When I ran my stage analysis framework on Cintas, it didn't fully check the boxes on any one clean stage, and it's really stuck between a stage 3 and early stage 4, as the long-term uptrend is technically intact, but the midterm momentum has rolled over. The anchored volume profile shows major accumulation between $160 and $180, and below that, the next demand zone is around $105 to $135. Above current levels, the heaviest supply sits at $200 to $205, which aligns with that 200-day EMA, the next key resistance area. Short interest on market beat is low at 1.77% of float, and it's down roughly 10% month over month, and indicating limited downside pressure from shorts. Okay, we've now reached the verdict. With Cintas, I'm projecting a base case 5-year total shareholder return of around 11% per year. Here's the breakdown. I'm assuming a 2.27% starting free cash flow yield, which is their current 44x price to free cash flow multiple. And then on top of that, we have a 12.44% free cash flow per share. And how I got this was using 3 analyst estimates of $2.636 billion in 2029 free cash flow and around 385 million diluted shares outstanding, with a 1.5% buyback yield also baked in. And then also a negative 3.39% valuation multiple change from that current 44x to a target 5-year median of around 38.3x price to free cash flow multiple. With this pretty solid base case TSR, a strong quality score, and an even stronger, more focused quality growth profile, Cintas is a company I want to own in my portfolio. Bottom line, I plan to buy a small starter position in the 180s, and I'm hoping that it can get down to the 160 to 170 support zone so I can buy more heavily into that area and build a position. I really like the business model around a recurring essential service and their future market share runway as the industry leader. I consider selling the position if ROIIC drops below 20%, operating margins compress structurally, or there's a large M&A that I disagree with strategically. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Cintas both insightful and actionable. If you enjoyed today's episode, drop a comment or take the episode poll. For real-time updates, follow me on X at invest091. Join me next when we'll take a break from deep dives and talk about key investing metrics. Until then, keep your investment smart.